Welcome back, everyone. Today, we are exploring a vital and highly strategic topic that every serious investor needs to master: how to construct a recession-resistant multi-asset portfolio. As financial markets cycle through periods of economic expansion, inflationary shocks, and inevitable downturns, the emotional temptation to panic sell or freeze your investments can be overwhelming. Traditional portfolios built solely around aggressive stock picking or static 60/40 models often buckle under the pressure of severe macroeconomic contractions. True financial resilience is not about predicting when a recession will hit. It is about engineering a multi-asset framework that smooths out volatility, protects your principal, and keeps your cash flow stable when times get tough. Whether you are nearing retirement, managing personal wealth, or refining your long-term asset allocation, mastering recession-resistant portfolio construction is the ultimate key to sleeping soundly through any economic storm. Let us start by examining the foundational philosophy of true multi-asset diversification. True diversification goes far beyond simply holding 50 different technology stocks or buying various equity mutual funds that all crash together during a market sell-off. Instead, it requires combining asset classes with low or negative correlations, assets that behave differently under varying macroeconomic conditions. When equities plunge during a recession, other parts of your portfolio should either hold their ground, generate steady contractual income, or experience capital appreciation driven by flight to safety dynamics. By blending global bonds, real estate investment trusts, REITs, and defensive equities, you create a robust shock absorption system that cushions your wealth against severe drawdowns. Moving hand in hand with diversification is the critical stabilizing role of global bonds and fixed income assets. High-quality government bonds and investment-grade corporate bonds serve as the ultimate anchor during economic contractions. When recession fears grip the market, central banks typically slash interest rates, causing bond prices to rise and providing a powerful counterbalance to dropping equity valuations. Furthermore, globalizing your fixed income exposure helps insulate your portfolio from localized monetary policy shocks or currency devaluations. While bonds may offer lower long-term returns during booming bull markets, their primary job in a multi-asset portfolio is capital preservation and reliable capital return when the rest of the market is bleeding red. Another major pillar of a recession-resistant strategy is the inclusion of defensive equities and high-quality dividend payers. Not all stocks are created equal during an economic downturn. Discretionary consumer brands, high-flying speculative startups, and cyclical industrial companies often see their revenues evaporate during recessions. In contrast, defensive equities, such as companies in consumer staples, healthcare, utilities, and essential telecommunications, provide inelastic goods and services that people need regardless of the economic climate. These businesses typically feature strong balance sheets, robust pricing power, and reliable cash flows, allowing them to maintain or even grow their dividend payouts when corporate earnings industry-wide are plunging. We also cannot overlook the specialized income-generating power of real estate investment trusts, REITs. Property is often viewed as a tangible hedge against economic instability, but buying physical real estate during a crisis is illiquid and stressful. REITs allow investors to capture the defensive cash flows of income-producing real estate, such as healthcare facilities, residential housing, logistics warehouses, and grocery-anchored retail centers, without the headaches of direct property management. During recessions, high-quality REITs backed by long-term leases and defensive tenant profiles continue to distribute reliable rental income, boosting your portfolio's overall cash flow stability while adding a non-correlated real asset dimension to your holdings. Finally, we must recognize that constructing a recession-resistant portfolio requires disciplined, periodic rebalancing rather than emotional market timing. A multi-asset portfolio will inevitably drift as different asset classes perform unevenly over time. Equities grow faster during booms, while bonds and defensive assets hold steady. Rebalancing forces you to systematically trim outperforming assets and buy undervalued, beaten down defensive holdings, capturing market mispricings and ensuring your risk parameters remain aligned with your long-term financial goals. As we wrap up today's breakdown, it is clear that building a recession-resistant multi-asset portfolio transforms uncertainty into a structured, manageable plan. By thoughtfully blending global bonds, defensive equities, and stable rates, you safeguard your capital and maintain steady cash flow through every phase of the economic cycle. If you found value in this deep dive and want to stay ahead of the curve on advanced portfolio management, asset allocation strategies, and wealth preservation insights, make sure to hit that subscribe button and ring the notification bell. Drop a comment below letting us know how you position your portfolio to weather economic downturns, and give this video a thumbs up if you want to see more content like this. Thank you for watching, and we will see you in the next video.